Have you ever looked at two ETFs that are supposed to be identical and then wondered, why is one pulling ahead while the other is lagging behind? Well, it happens all the time, and the answer is usually hiding in plain sight, buried in these tiny, tiny costs that really add up. So today, we're going to go full detective, uncover those hidden costs, and solve the case of the underperforming twin. Let's start by looking at the evidence.
So picture this. Two funds launch, just like twins. They track the exact same index, have the same sales pitch. They should move in lockstep, right? But then, just 6 months later, this puzzling gap appears. One is trailing the other by over 0.5%. It's not a big, sudden drop. It's more like a slow, quiet leak that really makes you ask.
And that right there, that is the central mystery we're cracking today. What's this invisible force that's dragging one of these funds down? It's not some single smoking gun, but actually a few sneaky culprits that, honestly, every single investor needs to know about.
All right, first things first in our investigation, we need to understand the clues. We're looking at two key terms that sound really similar but tell completely different stories, and those are tracking error and tracking difference.
Okay, let's break this down because it's super important. Tracking error, or TE, is what we're calling the wobble. It just tells you how volatile the fund's journey is compared to its index. A low TE means a smooth ride, but tracking difference, or TD, that's the shortfall. That's the actual performance gap you end up with. One measures how smooth the journey is, the other tells you if you arrived on time.
And this quote just nails it. You can have a fund with an incredibly low tracking error, a super smooth commute with no bumps, but if it's got a negative tracking difference, you're still showing up to the station a little bit late every single day.
And here's a real-world case file for you. A fund had a tiny tracking error, just 0.05%. I mean, that is an incredibly smooth ride, but its tracking difference for the year was negative 0.48%. So what's the takeaway here? A smooth ride absolutely does not mean you're not losing ground.
So, what is causing this shortfall? Well, our first suspect is the most obvious one, but it's the one people underestimate the most: fees. We're talking about the total expense ratio, or TER. Think of it like a slow, silent leak in your portfolio's hull.
You'll see a number like this all the time, 0.20%. It looks so small, doesn't it? I mean, on a $10,000 investment, that's just $20 a year. Pretty easy to just brush that off. But here's the catch. This is not a one-time thing. That percentage is quietly, sneakily shaved off of your assets every single day. You don't get a bill, you don't get a notification. It just happens like a constant little drain on your investment's value.
And that tiny daily drip, it compounds. So that $20 in year one, that becomes $60 by year three, and over $100 by year five. And get this, that's before you even factor in any market growth. It's just a constant compounding drag on your returns.
And this effect, it actually has a name: fee drag. And the slow gravity metaphor, it is perfect. It's this invisible force, and it is constantly pulling your returns back down to earth, year after year after year.
Okay, let's move on to our second culprit, the bid-ask spread. Now, if fees are that slow, silent leak, think of the spread as the immediate, upfront hit you take the second you make a trade.
So, if fee drag is gravity, the spread is like a speed bump. It's that small difference between the price you can buy an ETF for, that's the ask, and the price you can sell it for, that's the bid. You hit the speed bump once on your way in, and you hit it again on your way out. It's a transaction cost, not a holding cost.
And this is where so many investors get caught. It's a classic trap. You chase the fund with a fee that's just 0.02% cheaper, but you end up paying an extra 0.30% in the spread just to buy it. That saving you thought you were getting, it's gone, wiped out instantly, and you're actually in the hole before you've even started.
So let's look at this classic trade-off. You've got Fund A with a super low fee, just 0.06%, but a pretty wide spread. Then you've got Fund B with a higher fee, 0.20%, but a much tighter, cheaper spread. So, which one's the better choice? What's the play here?
Well, the answer is it completely depends on your timeline. For a short-term hold, say 1 year, that high initial spread on Fund A is just a killer. Fund B is the clear winner. But if you're holding for 5 years, Fund A's much lower fee drag easily makes up for that initial speed bump and it becomes the champion. Here's the critical point. Your holding period changes everything.
So now that we've unmasked the culprits, let's turn all this knowledge into action. Here is a simple 3-step playbook to make sure you're picking the right fund for you every single time.
First step, you have to define your horizon. Are you in this for a few months, or are you in this for decades? Step 2, compare the live spread. And don't just trust a static PDF fact sheet. Check it midday when the market is buzzing. And third, the most important step of all is to find your break-even point.
And here's the simple little bit of math that cracks the case. Just take the difference in the spreads and you divide it by the difference in their fees. The answer you get tells you exactly how many years you need to hold that fund for the cheaper fee to actually come out on top.
And finally, just a few pro tips to wrap this up. Always use limit orders, that way you control your entry price. Watch out for those promotional fee waivers that look so tempting. You want to model your costs on the real fee, not the temporary one. And of course, always think about how local tax rules or special accounts might change your final outcome.
This quote right here, it just perfectly captures the whole spirit of what we've talked about. A little bit of due diligence, a small tidy up today, checking those fees, checking those spreads, knowing your own timeline can save you from a massive scramble down the road.
So, there you have it. We've solved the case of the underperforming twin. The culprits, fees and spreads. And the key witness, time. The only question left is the one you see right here. Your portfolio has its own story, its own hidden costs. Now you have the tools to go find them.